Howdy and welcome to today's 5 with Fitz. I'm Keith Fitz-Gerald, and once again, thank you so much for joining me. You know, all three indices are ticking higher in the early going as I record this, which makes absolutely perfect sense. As we have talked about many times, including most recently this past Monday on Varney and Company, the perception of clarity may actually be more important than clarity itself when it comes to tariffs. So this makes perfect sense for one reason only. Patience and discipline are two of the most undervalued assets in the market today, in my humble opinion. And that's why you want to focus on having both. So here's my playbook. Number one today, who's really selling all those treasuries and what does that mean for your money? Now, chances are you've heard that the bond market is a wreck lately because U.S. treasuries got sold off. What you may not know is who is really doing the selling and why. Now, here's this skinny. Hang in there with me because this is high finance at its very best. And there is really seriously an impact that will come home to your wallet. But so you understand what's happening, big scale, big scheme, big money. First of all, China, which is the second largest U.S. creditor after Japan, holds an estimated $750 to $775 billion in U.S. Treasury securities. And lately, they've weaponized them. Like tariffs weren't enough. Oh my goodness. Anyway, China appears to be selling U.S. treasuries and converting the proceeds into German bunds or euros. And you can see that in both of those instruments, the bund and the euro, because they've bucked the recent global downturn, particularly in long-dated U.S. treasuries. Now, here's where it gets sticky and where you need to really pay attention. Again, this is mostly high finance, but do your best. Hang in there because it's really not such a difficult thing to understand when you understand the big, broad, sweeping things that drive today's markets. Selling treasuries drives prices down on every remaining treasury out there in the market, which means that at some point China will incur losses on its own investments, if that's not already happening already. At the same time, neither the euro nor the bund is deep enough to absorb all that selling. So, money is going to flow back to China, which means the yuan, its currency, will appreciate according to classic economic theory. Now, where most economists who are not traders go off the rails, though, is that China has only a few externally facing banks, meaning those banks capable of absorbing all that. And they're all state-owned, if memory serves. ICBC, CCB, BOC, and ABC, if my memory's right. I think the real damage is something Beijing is prepared to absorb or has already hedged based on my experience there. The bigger contributor to all of this is very likely Japan, where private insurance companies hold a boatload of U.S. treasuries. Now, they won't take the sell-off lightly, and my guess is that's why those companies and Japanese pension funds in particular have been selling U.S. treasuries to buy European fixed income. Now, then there's the hedge funds, who have been forced to unwind something called bond basis trades to avoid margin calls. Now, bond basis trades are typically used by big hedge funds who borrow money to buy U.S. treasuries while selling futures contracts on those same bonds to profit from the implied price differences. So, got all that. I mean, my brain hurts talking about all this. It's been a while since we've talked about this stuff. But again, this is high finance. You just need to understand the theory. I'd be remiss if I didn't tell you what was going on because it's kind of interesting, actually. But here's the thing. It seems complicated, but it's not really. Think about it this way. The VIG, Vigosh, just got too high, so the bookies who put on different odds and the outcomes are all those bets being adjusted to reflect that. So what does this mean for your money? Now we get interesting. The clickbait mongers are having a field day scaring investors to death that faith in America is faltering as a safe haven. And, that may be true from an emotional standpoint. It certainly makes for a lot of email, but quantitatively it's not. The world's financial managers are still buying the dollar when the you-know-what hits the fan. The sell-off is really about three things. Number one, China's playing nasty. Number two, Japan's managers are trying to make a trade. And number three, professional investors investing in treasuries simply borrowed too much money and they got pinched for doing that. It's like getting caught with your hand in the cookie jar if you're a little kid. So this will hit home in a couple different ways you'll feel in your wallet. If you're borrowing money, get ready to pay more on cars, on homes, on credit cards if this doesn't calm down. Other than that, and from an investing perspective, this is actually the good news. Stay focused on shorter duration treasuries and other bonds like those I recommend to the one bar ahead family. That's your ticket to entry. All right. Whew. Number 2 today, free Wi-Fi, but you're still going to pay for pretzels. Starting in 2026, American Airlines is going to offer free in-flight Wi-Fi on most of its fleet. Now, in doing that, they're going to join Delta, JetBlue, and United in turning on internet access and making it a loyalty battleground. Now, AT&T is picking up the tab if you're part of American's AA Advantage program. 90% of the jets are going to be connected, but older wide bodies are still going to be stuck in airplane mode, which I found out the hard way during a recent trip home from Italy this spring. It was super frustrating because Delta, which operated my flight, advertised that it was available, just buried the not on all routes part in the fine print. Anywho, airlines want to turn legroom into logins because connectivity equals customer stickiness. Now, Delta started this trend in 2023, and I've been using Alaska's version for years. United's going full Starlink for speed freaks at 35,000 feet. America's Wi-Fi used to cost more than 20 bucks or so. Now it's free-ish and a reason to join their loyalty loop. But what about airline stocks? People confuse the two. Those are very much still a non-starter in my mind. Thin margins, fuel volatility, labor showdowns, and of course, geopolitics with turbulence. The real play, and the one you want to focus on from an investing standpoint, is connectivity. Global internet demand is about to go full afterburner. Now, Grandview says it's a $2.87 trillion market by 2030, but I think that's actually an order of magnitude low. And I'm thinking, it's hard to get into space versus the cabin of the aircraft, but AST Space Mobile might be interesting, and I'm going to take another look at it under the circumstances because, it's not long. Anyway, number 3 today, Uncle Sam needs a new supplier. Yesterday. This is a much bigger deal than most people realize. China just slapped export controls on 7 rare earth elements. The kind of stuff we have to have for jets, missiles, EVs, drones, and more. Basically everything that's high tech. And it's a very simple premise. No license, no shipment. There are a handful of U.S. reshoring opportunities associated with this, and I'm exploring them with a little eye on doing some shopping. So stay tuned. We're going to be talking about this in the weeks ahead, I think. Now, Keith's investing tip in this instance is pretty straightforward. If you can't dig it, don't depend on it, at least not in today's world anyway. Number 4, is it time to buy Adobe? Adobe's taken a strategic stake in a British startup called Synthesia. I think I'm pronouncing that right. It's the company behind lifelike AI-generated avatars for corporate video content. Now, Synthesia now serves 70% or more of the Fortune 100 and just crossed $100 million in annual recurring revenue. The company lets users create AI avatars, boy, this is a mouthful, for enterprise training, onboarding, and marketing, and there's no film crew needed. Now, Adobe's backing, in my mind, underscores a bigger shift, and that's what I'm seeing, so pun absolutely intended. Video production is being reimagined through AI. The Synthesia CEO said, we're building the world's leading AI video platform for enterprise. Seems to me I heard similar things with GoPro, but, that's moot back in the day. Adobe clearly agrees, which is why they bought it. But should you buy Adobe? Now, I can make the case that AI eats Hollywood pretty quickly, but I'd rather put my money in choices that are farther up the proverbial food chain and dramatically more useful, not to mention profitable. One of my faves, for example, and I hope you're thinking along these lines, it has returned 41% over the past 3 years, or just less than double the SPX, which has turned in 23.22% over the same time frame. And again, whether you buy my favorite stock or whatever, I hope you've got this covered or you're thinking along similar lines. If not, you know where to find me. I'll be here. Welcome you to One Bar Ahead. Keith's investing tip in this instance is pretty simple. Successful investing isn't just about the stocks you buy. Sometimes it's knowing what not to buy, especially when there's a better opportunity staring you in the face. Speaking of which, let's get to number 5 today, what I call the diamond difference. Citi, B of A, Goldman, Morgan, they all beat earnings. Great quarter, but shrinking stock prices. Typical. But JP Morgan, still the one to own. I make a huge stink about why CEOs matter when it comes to investing. Sometimes the point of being a broken record, and I know that, so thanks for putting up with me. The way I see things, strong leadership isn't optional. It is the edge you want as an investor. Case in point, Jamie Dimon has steered JPM for 2 decades through crises, chaos, and bull runs alike. Most of the other banks have had at least 2, and in some cases as many as 5 CEOs during that time frame. Result? JP Morgan has delivered a whopping 1,076.54% return over the past 20 years, easily outpacing Goldman Sachs, Citi, B of A, and Morgan Stanley, all of which have turned in 544.87%, 36.18%, 32.66%, and 288.68% respectively. Put this into context, the SPY, which is a popular ETF, indexer's choice, has turned in a respectable 579.82%, which is still great, but a fraction of what Team Diamond has got on the table. So is this a coincidence? Not a chance. My POV, and something I really want you to take to heart, is you want to own the companies with the best bench because leadership matters to the pursuit of profits. Speaking of which, in today's bottom line, money is like water. Always remember that it will flow to where it's treated best. You got this, I promise. I look forward to seeing you tomorrow. Make it a great day.